Welcome to Bunnex Investment Group. So it's 20 pips that we need per trade from this trading strategy. It's actually very accurate if you do everything that I will say correctly. And from backtesting, we hit a high win rate of up to 85%. But before we go through, make sure you subscribe to this channel and check the notification bell icon so that you won't miss any of our videos as we upload. Still on that note, we have a free Telegram channel which we plan to send a lot of free signals in 2023. So as always, the fundamental starting point is counting of levels to attain bias. What is counting of levels? If you have been following our channel for quite a long time, you know that we use the institutional market maker method that we also teach, and it's actually going for $99 the full course. However, just a glimpse of how to count levels. It's basically location of impulses on the market, and we know that the market always reverse when the cycle is completed. So we have 1, 2 and 3. On the third level, that is where we expect to see a market reversal. And if the higher time frame cycle hasn't completed yet, we actually expect to see what we call a reset peak on the smaller time frames. However, this is actually a full video on its own on how to count levels, but in this particular video we are saying the first thing is to count the market levels and then attain the market bias. So by bias we mean attaining the market direction, so that we only take trend trades. However, within the forex industry there are several ways of attaining the market bias. Some actually use trend lines, some use moving averages and so forth, but in my experience I've seen all those being less accurate, and levels being the actually being the number one in terms of attaining the market bias. So firstly, to find the bias, we need to locate what we call a valid H1 anchor, and from there we start looking for market entries away from those anchors. We do not need any indicator, we do not need any moving average for this particular strategy. We only need to count levels so that we locate what we call valid H1 peaks or anchors. So here's the strategy definition, or in short, the summary of everything that we are going to illustrate. After attaining the market bias, that is knowing where the market is going up or down, we now need to see the Asian session range, right? We all know that we have three main sessions within the forex market: Asia, London and US. So the Asian session range is basically a range that incorporates the highs and lows of the Asian session, the highs and lows of the Asian session. And the Asian session range must be less than 50 pips for us to respect it. If it goes above 50 pips, we'll call it a blown Asian session range. So the tops and bottoms of the Asian session should be less than 50 pips apart. Then here are the steps to catch an entry. We've said the first thing is actually to see the Asia being less than 50 pips, and then the second thing we need to see an inducement move outside the Asian session range. For instance, let's say this is the Asian session range and we need to see a move going outside that Asian session, and after going out it should be in line with what the levels have told us, or in line with the market bias. Then after that we need to see price retracing to 50% of the Asian session at London opening or US session. So 50% of the Asian session will be, for instance, at this point we need to see this inducement move outside the Asian session and then retest of the 50% of the Asian session range like that. Then enter at Asia's 50% retest, that is at this point. That is where enter and we need to take 20 pips against a stop loss of 12 to 15 pips. So here's the illustration of what I've been talking about. Bias in this case will be going up. That means our anchor is at this bottom part, and then from there we have Asian range being presented or created, and then an inducement move 1, then retracement 2, and then retest of the 50% of the Asian range 3, like that. And we enter at this point to go up, like in this particular case, alongside the bias of the market. So let's now jump over the market so that we understand how this is done in real markets. So this is euro against Swiss franc, or basically euro CHF. The first thing that I've said is to first attain the market bias, and market bias, in my opinion, I've said I use market maker levels, right? So the first thing that I'm going to do is to count these levels so that I know where I am within the market. We have one, or the first day of rise, right? After the first day of rise, we have 2, right? And then the last one is this one, which is the third level to the upside. So after that, we expect to see an anchor, right? Unfortunately, in this case, I just want us to have a history of where we are going to be within the future. So after that, 1, 2, and 3 reverse. Then from a completed cycle, we expect to see a peak reset, which is this one. So in this case, we had a peak reset that is still continuing with an upward move. Therefore, this big fat W is actually a valid peak or a valid anchor. So our trades are taken on the M15 time frame. After location of this valid anchor, we now know that the bias or the market is actually in an upward trajectory from what we have seen from this peak, right? So going on the M15 time frame, we now will be looking for buys only, since the market is actually shown us. So this is actually an Asian range. This blue box is an Asian range, the upper part, the middle part, and the lower part, right? So we can see that from this Asian range, we have a valid Asian range because the pips between the upper and the lower are actually equal to 14, which is less than 50. Then the next thing is to see an inducement move, which is this one. After an inducement move or entry is a retest of the 50% of the Asian range. Therefore, this was a valid point of entry, and we were going to take our 20 pips. Some other traders loves to actually trade. They love to set pending orders at the 50% of this line, or actually go on the lower time frame so that you'd see a candlestick reversal that will be on the M5 time frame. You see a reversal, candlestick reversal pattern in this region. On the following day is where we had a valid Asian range, where we had an inducement move and a pullback to the 50%. So our entry was going to be on this point, and we take our 50 pips to the upside. In this case, there was no trade. Why? Because the retest of the 50% came before we had an inducement move outside the Asian range like that. So basically, our trades will be taken at the 50% after an inducement move has been done, but always watch out for some Asian ranges like this. There is 59 pips. This means it is a blown Asian session range. Therefore, we won't be taking any trades or looking at this particular market. On that note, we come to the end of this video. Thank you for watching. Like and subscribe, and check out our free Telegram channel where we'll be sharing free signals. See you on the next one.